Dear students, Assalamu alaikum wa rahmatullahi wa barakatuh. Today our topic of discussion is capital budgeting techniques. As you know, in the last lecture we have learned about the operating and financial leverages and now we are talking about capital budgeting techniques and what are these techniques and when we use them and what is the purpose of these techniques. So dear students, in simple words, if you try to make investment in any project, right, or if you want to purchase any asset or capital asset like plant assets you have like you want to purchase a car, machine, a building or whatever, then before to make decision, right, you have some techniques and these techniques help you whether you make investment or not. But keep in mind the cash flows from those investments must be given. So we have another chapter you must know about the cash flow, how to determine the cash flows coming from your potential investment, right? So whenever the cash flows from an investment are given, then you try to make sure whether this particular investment will provide you some benefit or whether it will generate some sufficient required return or not. Then we have some techniques by the name of capital budgeting techniques. These techniques can help you to determine whether this particular opportunity you want to make investment in is a better option or not, or if there are many options given to you to make investments, right, then you may select two options or one or three. Then you can decide based on these techniques that which option is better for you. So in simple words, if we want to try to make investment, whether the investment is to deposit money in a bank or to purchase any security, financial security, or to purchase a plant asset or whatever, but if you want to do an investment, then these techniques can help you to determine whether that investment will provide you your required return or not, right? So dear students, how many techniques we have in in this capital budgeting techniques? We have 4 techniques. Okay, one is look, project evaluations, alternative methods. We have payable period, this is one technique, internal rate of return, and net present value and profitability index. Initially we will work on one by one with example and explanation. So the first technique we are just working on it is the payback period. Simply you can write PBP, right, as a payback period. Okay, so what is payback period? So before to explain the payback period, here is one example. Julie Miller is evaluating a new project for her firm, Basket Wonders BW. She has determined that the after-tax cash flows for the project will be 10,000, 12,000, 15,000, 10,000 and 7,000. Okay, here is Julie Miller, right? And this individual would like to make an investment, right? And what are the future cash flows generated from this investment that he is interested in? For example, 10,000 in the first year and 12,000, 15 and 10 and 7,000. And how much investment is required for this project? $40,000. How much? $40,000. Okay. Now, what the Julie Miller is needing here The Julie Miller is determining to decide whether to make investment in this project, whether the 40,000 investment he is making in this project will give him, right, the return according to his expectation or not. But keep in mind the Julie Miller requirement here is to determine and to know about the payback in our example. So what is payback? I'm just explaining it here with this example, okay? Look here. The payback period is a period of time. Okay, before this, what is given here? For this project, assume that it is independent of any other potential projects that Basket Wonders may undertake. So this is independent project, right? Not dependent on any other projects in this business in the Basket Wonder is interested in. So independent means a project whose acceptance or rejection does not prevent the acceptance of other projects under consideration. It's mean the independent project is having nothing to do with other project, whether to reject or accept any other project depending on this one, or this project to be dependent on another one. So by the independent mean this is wholly different project. This is not an alternative option or not a comparison, just simply another project which is not related with the main projects or other projects of the Basket Wonder company. So that is why a project whose acceptance or rejection does not prevent the acceptance of other projects under consideration. Okay. So dear students, in the payback period here we have payback period is a period of time required for the cumulative expected cash flows from an investment project to equal the initial cash outflow. So what is payback? Okay, the period of time required. Okay, let me just the period of time required, okay, for the total expected cash flows from an investment project to equal initial cash outflow. How much is initial cash outflow here? And that is $40,000. Now, what is the payback period? Here you are interested that in how much time this $40,000 will be given back. Okay, whether in 1 year, 2 year, or 3 year, because you are interested to know about the payback. It means if you want to make investment of $40,000, then how many years it will take, right, to get back your $40,000 in 2 years or 3 years. And that is what we need to determine here. And now we are rejecting or accepting this project based on the payback period. For example, if the payback requirement period is 2 years and the project is giving you the initial outflow, this is the initial outflow or cash outflow or investment. So if your required payback period is 2 years and the project is giving you the payback period in 3 years, means after 3 years at least this 40,000 is recovered, then you are rejecting this project. Why? Because your payback requirement is 2 years, then you are expecting that the project must give you your initial investment less than 2 years. So if the project is giving you your cash back in more than 2 years, then you are gonna reject it. Okay, and that is the idea behind the payback period. So now have to compute and determine whether this project is giving $40,000 in the required period or not. Okay, for example, in this question, we are trying to determine about the payback period. So how this payback period is computed 3.3 years. It's mean in this example, if this company is making an investment of $40,000, then this $40,000 is given back to the company, the initial outflow or investment, in 3.3 years. Okay, in how much time? 3.3 years. Okay, how this 3.3 years is computed? Now just I'm showing you in Excel simply, right? Okay, look here. So look, dear students, here you have to just make it in two columns. Okay, in the first column we have years, right? Or just make it year. Okay, starting from 0, 0 means now, right? And then after 1 year, 2 years, 3 years, how much is the cash flows you are getting? Okay, how much investment here you have to make? In our example here, you have to make 40,000 investment, right? So look, in the 0 you have to mention 40,000. Okay, so show it with minus sign, 40,000. Okay, okay, these values just give it a comma here and make it with 0 decimals. Okay, okay, after 1 year, how much cash flow is generated? So 10,000, we have 10,000, and the second year is 12,000, and the third year is 15,000, right? Look, 10, 12, 15. So we have 10, 12, 15, and then 10,000, and finally we have 7,000. So dear students, this is cash flow. These are what? Cash flows. The first cash flow is the negative value. Why? Because here the cash is going out. So this is cash outflow, and all these are cash inflows. Okay, now we have a formula. If we need to determine the payback, what is the payback period? Okay, and that is what we mean by payback period. Okay, in this payback period we have a formula, and what is the formula? The formula is payback period is equal to A plus B minus C divided by D. Okay, so look, the payback period, and that is equal to A plus B minus C divided by D. Okay, this is a formula. Look, A plus B minus C divided by D. Now what to do? How to compute the payback period using this formula? Very much easy. We need to compute the cumulated cash flow. Okay, this is what is called cumulated cash inflows. So you have to mention the cumulative inflows, cash inflows we have. Okay, in the first year, how much we are receiving? After 1 year we are receiving 10,000. Just make it 1 decimal. Okay, in the second year, after 2 years, how much the total cash flow we will receive in 2 years? So we can say 10,000 and these two should be added. Okay, or 10,000 plus 12,000, this one should be added. How much total cash flow we are receiving in 3 years? It means 22,000 we are receiving in 2 years. In the third year, so equal sign, sorry, 22,000, and then 15,000 here. Okay, and then in the fourth year, 37,000 added with 10,000, and finally 47,000 added with 7,000. So dear students, this column is for cumulative cash inflows. Okay, okay, now we need to do, okay, so according to this formula, what is our A, B, C, D? You need to determine what value is A and what is B and what is C and D. So very much easy. Look here, dear students, we start from here. In the first year, just look in the first year, how much total cash flow you are getting in the first year? That is 10,000. Okay, and the second year, the total you are getting, for the two years you are getting $22,000. In the third year you are getting 37,000, and the fourth year you are getting 47. So you have to compare each value with the initial cash outflow. So in the first year it is not given back, in the second it is not recovered, in the third it is not recovered. Why? Because it is less than the 40,000 here. but in the fourth year it is more than 40,000. Look here once again, in which year the cumulative cash inflows is higher than the initial cash outflow. You can say in the year fourth. Okay, so 1 year before, what this is year 4, so 1 year before is 3. So we say the third year, this is our A. We call it what? Our A. Let me give it a name of A. So this is our A. I give it, our name is A. Once again, how to know which value? The third year, this 3 is equal to our A. Okay, this is A. Once again, if you want to know about this A value, so just compare the cash flows with your initial cash outflow. So in the first, second, third years, these values are higher, right? These values are higher from the cash outflow, but in the fourth year you can see the value is higher than the 40,000. So 1 year before is the third. In this third, we call it our value A. Okay, now which value is our B? Okay, so now, dear students, the cash flow we have next to this value, this is our C or D. This is our C, and this value is our B. Always keep in mind the cash outflow is our B. Okay, this is B. Okay, and the value next to the third year, this is always C. This value is C. Okay, in the cash flow in the fourth year, this is the cash flow in the fourth year, this is D. This is, we call it D. Okay, once again let me repeat it, dear students. Okay, first you need to know about A. How to know the A? Just compare all these values with the initial cash outflow. So in which year the cash flow is higher than the initial cash? In the fourth year. So the fourth year is the cash flow is higher, the total cumulative cash flow is higher. So 1 year before this fourth year is the third year. This third year is, we call it our A, right? And the total cumulative cash flow in this year, how much is the total cumulative cash flow in this year? That is our C, always, right? Next to the A, we have the total cumulative cash flow, that is always C. If your A is here, right, then the C will be 22,000. So if your A is here in the fourth year, then the C will be your 47,000. And keep in mind the cash outflow, always this is our B. This is what? B. Okay, now if the A is the third year and the C is the cumulative cash flow, right, next to the third year here, then the next cash flow, how much is the next cash flow after this in the fourth year? That is $10,000. This will be your D. So keep in mind, so if this 22,000 is your C, then 15,000 will be your D. So if the 47,000 is your C, then the 7,000 will be the D. And this is the way you have to first place all these A, B, C, D here in this question, and then put it in the formula, and this will give you the answer. Okay, so let me put it in the formula, right? I'm just computing the payback period. Okay, here equal sign, first we have A is equal to 3, right? And then we have plus the formula, then we have B is our 40,000, right? Or you can simply click on this cell, right? Or you can write 40,000. But if you click here, the value is negative here, so that is why it's better you should type 40,000, and from the 40,000 minus, in the formula we have C, 37,000 you have to minus. Okay, and then you have to divide it by D, and D is or 10,000. Once again, look here, 3, this is A, we put it A here, and then we have 40,000, and that is our B as it is in the formula, and then minus C, 37,000, and the whole should be divided by 10,000 and D. Okay, now press enter. We have 3.3. Okay, as you can see here, it is computed here 3.3. So you can say 3.3 years. Okay, this is the payback or the computed value. This is what we have computed, the payback. Now For example, in our question here, we check, yeah, just a minute. In this question, the payback computed 3.3 years. Yes, go next and check. The management of Basket Wonders has set a maximum payback period as 3.5. Okay, how much is the required payback period? You can say here in our example, the required payback period, and that is 3.5. Now I'm just asking you a question, dear students. Okay, this is the required. You need at least 3.5 years. Okay, you need that this investment 40,000 should be given at least in how much time? In 3.5 years. But the project is giving you this outflow or the cash outflow in 3.3 years, so the payback is less than the required. It means you have to accept this project. It means you can decide here to make investment in this project. Why? Because the acceptance criteria for you is your required payback period, and that is 3.5, and what is computed here is 3.3. so obviously you are making an investment here, as this project is giving you your initial cash outflow in less than your required years. Okay, so dear students, what is the acceptance criteria here for the payback? Acceptance criteria for payback: if payback is lower than the required payback, then the project should be accepted, right? Simply, otherwise not. So dear students, this is acceptance criteria for the payback period. Okay, now you have learned the first method, and that was the payback period, that have to compute the payback. Okay, so the first method you have learned about the payback period. Now we are going into the second method, that is internal rate of return. So dear students, before to discuss internal rate of return, so we have some strength and weaknesses of payback period. You should know about it. Okay, what are the strengths of the payback period? The first is easy to use and understand. So it's very much easy and simple method you have learned. Very simple. The second strength we have can be used as a measure of liquidity. Okay, liquidity, it means you can determine how quick you can get back your initial amount, and that is what we are mostly concerned about. Okay, that if you want to make investment, right, then how quicker you can get the value of your investment back, and that is what we mean by liquidity. Okay, how you can convert back the asset into the cash. So can be used as a measure of liquidity. So if you want to determine, one way is just to use a payback period, and also easier to forecast short-term than long-term flows. Okay, if you want to know about the short-term flows, right, how much cash flows are generated in the first, second, 3 years, depending on how much is your required payback period, then you can easily know in the first 3 years whether the cash flow is the cash flow which is given, that is sufficient enough just to meet your required payback period duration or not. So simply, dear students, so if you want to know about the short-term cash flows, yes, the payback period will tell you somehow about it, but the payback period is not telling you about the long-term flows, what will happen in the future, in the next. Okay, next, whether the cash flow will decrease or increase. So that is why we have in the weaknesses here, okay, it does not consider the cash flows beyond payback period. So in the beginning or in the closer period, you can know about the cash flow. If they are according to your expectation, then it's okay, you will accept the project. But the payback period is not telling you about the cash flows in the future. What will be the trend, whether the cash flow will drastically decrease or not. So that is why one of the weaknesses, it does not account for total value of money concept. If you remember, we have a concept by the name of time value of money, and the time value of money is telling you that based on the current prevailing interest in the market, what is the present value of all these cash flows we have, right? What is the present value of the cash flows, okay? Then for example, here we have an example. So these are the cash flows. So now you are paying $40,000. This is your investment, but the payback period is not telling you that what is the present value of all these cash flows now. Okay, if you remember in the IRR, internal rate of return initially will work, that we are comparing the present value of all these cash flows, right, with the project price or the initial cash outflow. So that is why the payback period is not considering the time value of money. Maybe if you are interested about the required period of 3.5, maybe the project is giving you less than the 3.5, like in 3.3 the project is given. But according to the time value of money, maybe this project is expensive, or the 40,000 what you are paying is a higher price, right, considering the time value of money. But look, that factor of the time value of money is not taken into consideration in the payback period method. So this is one weakness of the payback period. The second weakness we have is does not consider cash flow. As I have explained, that nearby cash flows, you can determine how much the project will give you, but the cash flows in the future may not be given. For example, I'm just making it simple for you. You want to make investment here. So in this project, we have investment like $10,000 and $20,000, right? In this, and then we have $15,000 and $40,000. You are interested in how much time back, for example, this project is giving you your initial cash outflow. Okay, I'm just giving you an example. This is a 0 year and you're just making investment, and your initial investment is $40,000. Okay, so $40,000 somehow this is given in the 3 years. You the first 3 years, if you add it, look, if you add these three values, so it is more than 40,000. It means somehow this project, the initial cash flow of this project is given, right, and 3 point somewhere, right? But what if you want to know the future value here? The future value is given 2,000. Okay, in the 5th year the value is given 5,000. In the 6th year there is maybe some negative cash flow. You have to pay some losses like this, right? 10,000. So look, these are the future cash flows. In the 7th year there is some 0 maybe. So that is why if you are interested only about your payback required period, so the project may give you in the 3 years, and you may be happy that the project is giving you in your initial investment in 3 years, but you don't know what will happen in the future, because these parameters in the future are not taken to the consideration to decide about it. Why? Because in the future situation or the future cash flows are negative or 0 or too much less, then that will tell you the project is not really good. Maybe there are some other projects with initial cash outflow are lower, but in the future the potential cash outflow is coming higher, too much higher. So dear students, that's why here the payback period is not taking into consideration the cash flows beyond the payback period, the required payback period. Okay, the cutoff period is subjective. It means the cutoff period, the period what you have decided is 3.5. This is subjective. So if you have decided that your required period is 3.5, so the project may be giving you your initial investment 3.3 year, then according to your expectation or requirement the project is good. But according to some other people, so for example there are many other investors, they are interested the project should give this value back in 3 years. So for them it is not acceptable. For those the required period is 3 years, this project is not acceptable, but for you it is acceptable. So look, this is what is called the cutoff period. So for you the project is acceptable, for other the project is not acceptable depending on their required payback period. So dear students, absolutely you cannot decide about the goodness or about the potential yield or the benefit generated suitable according to the market or not. So that is the point, dear students, that when the cutoff period is subjective, then it's mean this method is not telling you absolutely whether this project is good or not good. For some it is good, but for some it is not good depending on their cutoff period. So dear students, you have learned about some strength and the weaknesses of the payback period. Now dear students, we are going next for another method, and that is internal rate of return. Okay, so what is internal rate of return or IRR? Internal rate of return is the discount rate that equates the present value of the future cash flow, right, future net cash flows from an investment project with the project's initial cash outflow. Okay, so dear students, look here, we have initial cash flow, and that is this is our initial cash flow. Okay, in our example here, if you see here, this is our initial cash flow. Okay, now we are not working on this method, so let's just work here. Okay, the first cash flow we are paying is initial cash outflow. Okay, and then the next CF1, this is cash flow after 1 year, and it's cash flow after 2 years and 3 years. Like if you see this is CF1, CF2, 3, CF4 and CF5. Okay, this is a formula, and what is the explanation or the concept of the IRR? IRR is the discount rate that equates the present value of the future net cash flows from an investment project with the project's initial cash outflow. So dear students, what is the rate here? This IRR is actually here the discount rate. This what we mean, I'm just explaining it. So this is the discount rate. So what is the discount rate? What is the rate or the interest or any rate what I put it here, right, and discount all these future cash flows, and that is giving me initial cash outflow exactly. So this rate which equals all the future cash flows present value with the project initial cash outflow, then this rate is called IRR. So let me explain it with example practically. So look, dear students, here, for example, dear students, I'm just giving an example. If you want to make investment, you want to make investment, how much investment you make, $10,000. This is what you want to make investment, and how much interest you are getting after 1 year, and that is 10%. So a year, that is 1. It means if you want to make investment 10,000 in a project, and that can be anything, or that can be bank. You want to make deposit in a bank for 10%, and after 1 year you are getting 10%. If you remember, in the business finance course you have learned about the time value of money, and the formula of the future value in the time of value of money, it was like this. So future value that is equal to, if you remember, right, the present value times 0. Now how much is the present value? And then the present value should be multiplied with 1 plus I, right? 1 plus I, this is interest, and raised into power n. You remember this. So dear students, if you want to make investment $10,000 today and the bank is giving you 10% interest, so how much total fund will you have after 1 year, or how much will be the future value after 1 year? Okay, so this is n, this is what? N. So dear students, look dear students, I'm just using this formula here. So the future value of this project is equal to equal sign the present value. How much is the present value? And that is $10,000 into 1 plus how much is the I interest, and that is 10%. So you can just write 10%. Also you can write 0.1, no problem, whatever you can use. So I'm just using 10%, and then raise into power 1. Okay, so this is, we have power 1. Where is a power 1? Or simply you need not to just make it power 1, as it is 1, again we will have the same value. Okay, just like this. If you want to make it power 2, so just make it power 2 or 1. So now how much is the future value we will have, and the answer we will have is equal to, the problem is here, okay, $11,000. Okay, if you want to make interest here $10,000 after 1 year, the future value we will have after 1 year is $11,000. So $10,000, this is the interest rate, so this is the present value, and this is the interest, and after 10 years, after 1 year, you will have $11,000. This is called a future value after 1 year. Now dear students, if I need to know how much is my present value, to get or compute the present value back, I'm just using another formula we have for present value, and that is let me just write it here. The formula for the present value, the present value for n year, this is the formula, is equal to the future value, the future value for n year divided by 1 plus I raised to power n. Okay dear students, so this is the present value formula. I'm just asking you a question here. If you want to get back how much is the present value, right? If in this question the present value is given as we found, so this is our present value is 10,000. So if the future value is given and the interest rate that is 10%, and after 1 year, okay, so how much is the present value? Right, this is what we need. Okay, present value, how much is the present value, and here we computed the future value. Okay, so the future value we found, that was 11,000. Now we need to find out the present value back. So we are just using this formula, right? So for the present value, equal sign, right, and then the future value, just how much is the future value? 11,000, and then divide this 11,000 by 1 plus 10%, right, and raise it to power 1. So dear students, look in this formula. I'm just explaining it here for you. If I'm just removing this 10%, assume there is no 10%, there is 0, okay, or it is not given. I'm asking you that what is the rate if I'm just putting it here, and that is giving me exactly $10,000. Okay, once again I need to find out the $10,000. So what is the rate if I'm just putting it here, and that is giving me the initial cash outflow? How much is the initial cash outflow? The 10,000. This is my investment. So there is only one value, and that is 10%. Okay, if you just put here 9%, so that will not give you 10,000, and if you put 11%, that will not give. The only value which will give you the $10,000 back, that is 10%. So we can say the 10% is internal rate of return or IRR here. Okay, look in this formula. If you wanna get 10,000 back, okay, so look, we have $10,000. If you make it 9%, so that will not give you 10%. So you can say, if in my formula I just need present value, how much I need present value, $10,000. This is my present value I need, okay, and this is equal to future value is given, and that is 11,000. okay, so 11,000 is my future value. When you divide it on this, okay, 1 and then plus, I don't know about I is not given, this is not known, okay, divide raised into power 1. So now I'm asking you a question, what value that I should put it here in I, right? What value that I should put it here in I in order to give me exactly $10,000, and that is only 10%. So you can say the internal rate of return, the interest rate here, which equate the future cash flow. How much is the future cash flow? 11,000. The interest rate here, this interest rate is called the discounting rate, okay. So the discount rate here, which equate the present value of the cash flow with the $10,000, that is 10%. No any other value can equate or make equal this $11,000 when you discount it back and to get $10,000. So the only value that is getting back the $10,000, that's called what? IRR, or 10%. So that is why it is called internal rate of return. IRR means what? IRR means internal rate of return, okay. So it's mean the internal rate here, which is giving you back this $10,000, that is 10%, okay. So in this example, dear students, which is given in our example here, and that is what is explained here about IRR, the discount rate, okay, that equates the present value of the future net cash flow. So look here in this example, the discount rate, which one is the discount rate? 10%. So the discount rate that equate the present value of the future cash flow. How much is the future cash flow here? $11,000, with equated with the present or the initial cash outflow. So that rate is actually called the IRR, or internal rate of return. So IRR is a discount rate that equates the present value of the future net cash flows, right, from an investment project initial cash outflow. So dear students, in this example, these are the future cash flows, as you can see here, and this is the initial investment. So what rate I should put it here in order to discount all these future cash flows and get me back the initial investment? So now we practically just solving one example here, and you will get the IC, or initial cash outflow, by IRR, okay, the formula of IRR. So look, dear students,